Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I am Michael Bull. Thank you for being with us. Our show today is brought to you by my company, Bull Realty, where we sell commercial properties mainly around the Southeast U.S. We do a lot of bank work. We do a lot of distress work. If you have any commercial real estate need in the country, feel free to reach out to me and we will get you with the right folks. My email is an easy one. It's michael@bullrealty.com. Well, we're going to talk about the distress market. We're going to talk about lenders, what's going on. I think a lot of people are wondering where are we right now as far as distress goes, delinquencies. What are lenders doing with notes and with properties? Well, let's find out. Please welcome my guest. It's Lonnie Hendry, and Lonnie is with Trepp. Lonnie, good to see you. Thanks for joining us, sir.
Thanks for having me, Michael. Great to see you as always. Appreciate it.
Well, obviously, you guys do a great job of monitoring the debt market, and we're all kind of curious. How are delinquencies running right now? What are you guys seeing? What's the trend?
Yeah, so we just finished up our December delinquency report. So we wrapped up 2024, and for the CMBS market, delinquency finished the year at about 6.57%. So significantly higher than what we started the year off at, and not anywhere near where we were at the peak of the Great Financial Crisis, which we hit in July of 2012 at 10.32%. So we're still considerably less than what we were at the GFC. But 6.5% delinquency is nothing to sneeze at. And, the headline coming out in December was that the office sector hit its all-time high in the delinquency at 11.01%, eclipsed the previous high water mark of 10.7%, which also happened in 2012. So on the distress side, there's a lot of headlines. I do think we're in a little bit of a tale of two markets, though. For every negative story, we are starting to see almost a one-to-one or maybe even a little bit more of the positive stuff coming out of the marketplace as well.
Yeah, that's interesting because just keying on the office sector, I do a newsletter for special asset folks around the country, and I actually sent it out today. If any of you guys want it out there, email me and we'll put you on the list. And I'm talking specifically about office because, well, one, I sell office buildings, but also do a lot of distress work. So let's key in on office for a second because that's where a lot of the distress is, right?
Yeah, office is definitely where the overwhelming majority of the distress is. Multifamily saw a pretty significant uptick over 2024. It finished the year just under 5%, but office, at 11% is significant. And so we put out a stat the other day on the delinquency side for office. There's about $17 billion worth of outstanding CMBS office loans that are currently delinquent. And so it's no small number, but at the same time, I think we're finally getting some sellers to capitulate. We've seen lenders and borrowers that can reach an extension or modification agreement employ those tactics. And for some, the reality of just where their office is truly hit from a value perspective, I think is starting to come to fruition. So I think we'll see an increase in activity in the first couple of quarters of 2025, where borrowers that are just underwater finally offload some of those offices. The basis gets reset at something that's more favorable for the incoming buyer, and we hopefully see some of these office buildings come back to life in maybe a little bit new, amenitized fashion versus the old dilapidated, functionally obsolete status that they've been in the last couple of years.
Yeah, good point. I'm seeing the same thing. We're seeing a lot of office buildings. We're headquartered in Atlanta, and in the Southeast, we're seeing some of these buildings get torn down and the land being redeveloped. And we're also seeing some get converted to other uses. So, when you combine with some of these selling at a lower basis, hopefully it just all gets a little healthier, right?
Yeah, I think that's the idea. There was some positive news over the last couple of weeks where Amazon had a return to office mandate that they put out publicly that they're going to be requiring their office workers to come back to the office. JP Morgan this last week announced that they're going to be requiring their teams to come back 5 days a week. So if we see some of those things actually take place, we also have with the incoming administration, the creation of the Department of Government Efficiency, or DOGE, which has a pretty significant focus on the GSA and the leased space that the government occupies. I think we're going to see some activity there, either in the form of cutting leases that are no longer needed, or hopefully seeing more people back in the offices where they do have leases in place. So I'm optimistic heading into 2025 that we're maybe finally going to see a positive turning point for the office sector. I don't think that means that distress will go down immediately. I wouldn't be surprised if the delinquency rate, which is sometimes a lagging indicator, maybe peaks out closer to 20%. But I do think, as I mentioned, for every one of those data points, there's going to be one plus on the positive side of, sales transactions, leasing activity, return to office, et cetera, that's positive.
Okay. So office delinquency right now in CMBS is at 11%.
Yes, sir, 11.01%.
And
So,
you
and go ahead.
and you think it might go to 20%.
I think so. We've looked at the upcoming maturities. There's about $36 billion worth of office maturities in 2025. It's pretty heavily weighted towards the first 2 quarters of 2025. So if you just look at the delinquency trends over the last couple of quarters with the upcoming maturities, I would expect to see delinquencies at 12 to 14% in the first 2 quarters of 25. That's just on maturity defaults. If you factor in any other external factors, I think you could see that number higher. I'm not going to go on record saying I think it's 20%, but I wouldn't be surprised if we end the year in 2025 having hit a peak of around 20%.
Wow, interesting. And you mentioned GSA. Obviously, they're a big office user and real estate user, and you mentioned two of the things. I think our audience was curious on your thoughts on. You talk about, well, maybe Doge comes in and says, all right, well, let's get some of these office leases eliminated, but also get some of these folks back to work. So is that a neutral event at the end of the day? What do you expect?
Well, so it's interesting. I had the pleasure a couple months ago of going up to DC and meeting with Senator Gary Peters from Michigan and talking some commercial real estate with him. And I asked him very directly around getting office workers, government office workers, back in the office, and he was very supportive and said that they understand that that's a challenge that needs to be addressed. So I do think you're going to see a concerted effort on both sides, trying to make the government leasing more efficient and right size that to where it needs to be. But for the leases that stay in place, I do think you're going to see an effort of trying to get people back to the office. Now, if they eliminate a lot of square footage through this efficiency play, that could have some negative consequence for the office sector. My supposition, though, is the government is just not very efficient at moving fast or by definition being efficient. So I don't know how effective Doge will be in 2025 as it may be for the cutting of the lease side. But I do think there's some momentum on getting people back in the office. And from my perspective, we track the top 5 tenants at Trepp across all the multi-tenant properties in our data set. And the government sector is some multiple of any of the other largest tenants in the data set. It's like 5 to 1. So if we can get people back in the office on the government side, I think it acts as a really strong catalyst to get some of these private sector companies on that same bandwagon and start bringing their people back to the office as well, which could have really positive ramifications for the sector on a holistic basis.
Yeah, that's a good point. And I have some insight on that. I sell GSA lease buildings, and I was talking to the GSA commissioner, and they were talking about how they're going to do work from home. And, there's going to be more efficient use of office space. But at the same time, we're selling a large building with 200 employees. And the lady running that building and that operation said, "There's absolutely no way." The folks that she said, "We can't operate. We're so inefficient. It's terrible. I can't perform without these people back." So it'd be interesting to see, how that works out.
Yeah, I wouldn't be surprised if we end up, there's a lot of headlines, there's a lot of talking. I think in practice, things will just move a little slower probably than what people would like on the efficiency side. And these problems exist. I mean, the GSA, for people that maybe aren't familiar, they had a pretty laissez-faire work from home policy prior to COVID. I mean, they were on like a 3-day in office work regiment before COVID. So it's going to be challenging to be more stringent after COVID than it was before COVID. But I'm optimistic that even without the GSA, just the broader office narrative has finally, I think, hit kind of troughed out and maybe plateaued. And it feels like there's some optimism around the sector. We've seen some big players. Cousins REIT just bought a Google occupied office property in Austin at a really nice, attractive basis for them. which shows some institutional capital flowing back into the office sector. And we've seen several other deals. We've seen some big refinancings to round out 2024. Rockefeller Center just got a new refinance done in the CMBS market. I think it was about 3.6 billion. It was the largest CMBS transaction on record ever. So there's definitely been still that bifurcated higher end Class A stuff getting preferential treatment. But I'm optimistic much more heading into 25 than I was at the start of 2024.
Yeah, it's good to hear about these new loans. So let's talk about that. We need new financing to take care of some of these maturities, right? What are you seeing for originations?
Yeah, so it's really interesting. It's kind of it's sector specific. If you're looking at bank originations, they're down fairly significantly from the peak of, call it, 2021. With the interest rate hikes and some of the additional scrutiny that they started seeing from regulators after the bank failures, the banks have really pulled back on the lending spectrum. So that origination is down in 2024 fairly significantly. But that just creates opportunity for some of these other lending markets. And in the CMBS world, you saw origination volume go from about 43 billion in 2023 up to 108 billion in 2024. So it was up considerably in 2024, and actually was pretty close to where we were in 2021, which was kind of an anomaly given the government stimulus and the post-COVID lockdown of 2020. So I think CMBS is poised for a really strong 2025. The agencies, Fannie and Freddie, saw a slight pullback. They were in the $40 billion range, almost $50 billion in 2023, and they were just at 39 and some change in 2024. But if you look at the last 2 quarters of 2024, they saw some really strong pickup in origination volume. So I think they're poised to start the year off really strong in 25. So from an origination perspective, I think the pullback across the spectrum that we saw in 2023 when interest rates went up 500 basis points, I think has started to abate. And you've definitely seen some winners, notably in the CMBS market, where origination volume has been really, really strong.
Yeah. Well, that's good news. And let's talk about rates. With the Fed lowering the rates, we all hope, oh, well, that's going to help interest rates. But obviously, long-term rates have not come down. They've kind of went up a little bit because of the 10-year, right? So being so high. So what do you expect moving forward?
I think what we're seeing right now is just how the real estate market's not tied to the federal funds rate. We've seen that play out now. Like the Fed pivoted about 100 days ago, and the 10-year Treasury, as you mentioned, has stayed the same or gone up during that time period. I think there are some external factors that play into that. Obviously, we had a presidential election back in November. We're going to have an inauguration here in January. And so there's some, I would call it perspective differences around like what this new administration means for the markets longer term. A couple of things to be cognizant of is some of the fiscal policies that President-elect Trump has talked about and touted are perceived by the academic world and the economist as being inflationary. So even though the Fed feels like we've kind of gotten inflation in check, and so they've pivoted on the rates, I think the markets broadly are pricing in some of these potential inflationary fiscal policies that may be implemented under a new Trump administration. And there's just a lot of global uncertainty in the market right now. And so we have a lot of stuff happening outside the US that causes some concern for people. So unfortunately, I think the higher for longer narrative has turned into the higher for longer reality. And I don't see anything in the first couple of quarters of 25 that would suggest we're going to see a massive reduction in commercial real estate lending interest rates. The one benefit is maybe that with that realization of this higher for longer is you're starting to finally see some capitulation and some price correction to what's actually the market, which I think people were a little bit hesitant to do latter part of 23 and throughout 2024.
Yeah, that's a good point, Lonnie. I was talking to a seller on a $90 million asset last night, and they were asking me about rates and the market, and I used the higher for longer phrase. And then I stopped and said, you know what, that's kind of what a lot of us say. But I've been in this business a long time, and I don't know if it's really higher for longer. Maybe it's more historically normal interest rates for longer.
No, I agree with you, and we've been making that point on our podcast show is that if you look at the current rate environment, it's not higher; it's just higher than the 5-year anomaly where we had 0% interest rate. So if you back out that 5 or 7 year, ZERP run, the rates that we're seeing today are not outside of historical norms. In fact, if you look at like a 50-year running average, we're probably below the 50-year average from an interest rate perspective. So I think the challenge is just the mathematical reality of having an in-place loan at 3.5 or 4% and having to refinance into something at 6.5 or 7. The math is not in your favor if you're a borrower. And so even if these rates are in line with the historical averages, for them on those individual transactions, it's costing them a lot more money for the same property to get financed. And it's a tough pill to swallow. I get it, but I'm with you. If you look at these rates, like, nobody should be complaining about the market being stifled by these rates. We've had markets operate in this rate environment for 30, 50 years, easy.
Yeah, and much higher rates, right? And to that point, with these maturities, you talked about just in the office, you said 36 billion in
Yes,
maturities
sir.
this year, and these rates being quite a bit higher than really probably all those most all of those current rates. What do you see lenders doing trend wise these days? We just sold a big office building for a bank, and they went ahead and did a friendly foreclosure to transfer the keys, and we sold that. But it seems like a lot of these banks have been kind of holding off and trying to do workouts and put things off. What are you seeing today, and what do you expect moving forward?
Yeah, so I think we're seeing banks come to the realization of what the current market is as well. I mean, they were in shock, I think, the latter part of 22 and into 23 and 24. They effectively started, doing some deep dive analysis on their portfolio allocation and where their perceived losses may be. And I think the last couple of quarters of 24, we started to see some movement around them getting some of these, assets that are not functioning or producing for them off the books. And so we've started to see some fairly large bank portfolio transactions at reasonable haircuts, call it in that 8 to 10% range to par. And I think we'll see more of that heading into 2025. I think everyone has effectively recalibrated their portfolio. They understand now. We did an analysis of the top 100 bank holding companies across the US, and the allocation on the CRE book was around, call it 15 to 20% office concentration. So it wasn't like it was 60% office or 80% office. It was, 15% plus or minus office. And not all of those offices are non-performing. Maybe 20% of the 15% are non-performing. So I think they've got a much better grasp of kind of where they sit with their, bad office loans, and you're going to start seeing them offload them strategically throughout 2025. And again, I think that speaks to some of the optimism I have around just that market transaction velocity picking up as people can buy assets that maybe aren't performing today, but at a really good basis, and they can reposition them in a way that makes it profitable for them.
Yeah. Well, it's interesting. We have a transaction now on an office building that's fully performing, long-term leases, really high credit, and the bank is forcing the sponsor to sell the building or to pay them off, even though it's operating fine. So it's kind of interesting to see that. All right, we want some of these banks just want all the office off, regardless if it's performing.
Yeah, I think that there's definitely some of that. It's a smaller subset, but clearly there are some lenders that have said we're going to reduce our allocation to office effectively to zero. I think that's short-sighted, and especially in the case you describe where it's performing, credit tenants, et cetera. I mean, I think it's just like anything else. Broad brush approaches to real estate rarely work because real estate's a local and sometimes hyper-local endeavor. So I think you have to look at every asset, you have to look at every tenant, you have to look at every operator, and you have to figure out what makes sense. And we've seen a lot of borrowers come to the table and pay down the existing mortgage in exchange for a 12 or 24-month extension or modification. So it's not like borrowers are unwilling to contribute capital for assets they still believe in. But for lenders or for banks in particular, sometimes they're getting other pressures that we may not be privy to. And so they may be forced themselves to try to offload some of these office properties. So I in every instance, you're going to be seeing more transactions in 2025 for various reasons, as you've outlined.
Yeah. In the last recession, I had an office building loan that I had, and one of the big three banks in the country had the loan, and they were and it was the worst time. You could hardly get financing or sell a building at the time. And they said, we want you to pay us off. And I said, well, I don't really have that ability. They said, well, we're going to send our guy out. We're going to foreclose on you. So, it's performing. It's in beautiful shape. I have great credit. Everything's perfect on it. And they said, yeah, it's just coming from the top. We got to get these office loans off. Then I asked the guy when he was there, I said, so if you guys foreclose, do you know who your bank uses to sell foreclosed properties in the Southeast U.S.? I said, no. I said, it's me. So you foreclose, somebody else in the bank is going to call me in a month and go, hey, Michael, we need to sell this. It's like, let's think this through. Let's not cause problems we don't have. And on the origination side, I think for lenders, it seems to me to be a wonderful time to originate loans, right? The spreads are good. You don't have as much competition. You can really build good relationships, right?
Yeah, we've been on record saying that lenders that are active in this market are making the best loans they've made in the last 5+ years because they have the ability to get the terms that are favorable for them. They have the ability to do additional due diligence, require additional forms, et cetera, to make sure that they fully understand the collateral and the value, of such before they make the loan. And so I'm with you. I think for people that have leaned in and maybe taken a slightly contrarian approach, they're going to see outsized returns on the back end of this. And for borrowers that have formed new relationships with those lenders, they're not going to forget that. And I think it's, that's what makes the lending cycle fortuitous for banks, is when they're able to create those relationships that, go and extend beyond downturns, et cetera. So not everyone has that ability. And as you mentioned, and we've talked about, some banks are getting pressured and they're in a different position. Their balance sheet's not in a place where they can be active in today's market. But for those that can, I agree with you. I think it's really going to set them up for success as we come out of this downturn.
Lonnie, you talked about originations, and there's a lot of private equity out there and funds that like to be in the first position these days. How much of the originations last year were really private lenders, and how much of the piece of the pie are they taking?
Yeah, so I don't have exact numbers on that just because it's more opaque, but I can tell you it's a growing part of the pie. These non-traditional lenders, private equity, debt funds, et cetera, are definitely seizing the opportunity on the lender side during this disruption. And we've had several people on our podcast show where we've talked to them about how they're executing certain strategies. And for a lot of these lenders, they're able to get what they call equity-like returns in the debt space. And if the asset goes bad, they're in a position to take the asset over, which they're good at doing. So unlike traditional lenders. And so I think, you're seeing a much more professional approach to this downturn from some of those players, where they're strategically making investments or loans and deals where they have an interest, if it doesn't turn out well, for them to own and operate the real estate themselves. And so I think you're going to continue to see these private equity firms, debt funds, et cetera, being more and more active, even as the market rebounds. I think they've really filled a gap. And some borrowers like working with them more than they do some of the regulated traditional bank loan folks that they've been dealing with for the last 30 or 40 years. So I'm pretty confident that we're going to see this, shadow lending or non-bank lenders continue to be a huge component of the CRE landscape.
Yeah, and to your point, for the most part, they really understand the collateral, right? They understand the real estate. I think we sold 3 foreclosed properties for private lenders last year, and in every case, they netted over par.
Yeah. I think their understanding of the local markets, their understanding of how to operate is just at a level that's difficult to recreate if you're a traditional bank lender. And so I think you're going to see them being more aggressive, and we've already seen it. They're willing to take chances on buildings that traditional financing won't. And to your point, they're in a position where even if things don't turn out the way that they should, they can still make out on the deal. And so it's an interesting time. I mean, you've been in this business, so have I, for multiple downturns, and it seems like with every downturn, there's some new avenue or some new facility created that kind of becomes mainstream. And I think some of this private lending has kind of hit that critical mass.
Yeah, good point. Lonnie, what would you leave our audience with to think about for 2025 related to the debt market?
Yeah, I think 2025, it's interesting. I asked a question at an event the other day, and we had this moniker of survive till 25, and someone at the table said they think 25 is just going to be more of 24. And I kind of like that. And I think for the first couple of quarters of 25, you're basically going to see a continuation of the last two quarters of 24. And I think depending on what happens with some of the tariffs and some of these other things once Trump gets in office, if it's inflationary and it's what the economists are predicting, you may see a little bit of contraction on the CRE landscape the latter half of 25. If they're not as impactful on the negative side for inflation and it's kind of status quo for that, I think the latter half of 25 could take off like a rocket ship. I think there's a lot of people ready to get back in the CRE business. You've seen Blackstone and some of these large players make some pretty hefty bets in the last half of 2024. So I'm really optimistic heading into 25 that we could at least see a continuation of the last two quarters of 24, but I would not be surprised if 2025 ends up being a really, really active year, both on the origination and transaction side.
Good. I love it. That's what I'm hoping for as a broker as well. Well, Lonnie, thanks for joining us. Great information. Appreciate you being on the show.
Yeah, always appreciate it, Michael, and good luck to you and your firm. I appreciate the time. Thank you.
Great. Thank you. And thank you for listening around the country. Look, you can hear more from Lonnie Hendry at Trepp. Check out Trepp. They've got a lot of great services. They have a great podcast. Do check them out. I do share our show. If you have any ideas or thoughts or questions for me, reach out to me. My email is an easy one, michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.